All right. Hello, everyone. I hope everyone's doing well. Today, I will be talking about dividends and share buybacks, which can sometimes kind of be misunderstood. I'm going to be talking about when a company should return cash to shareholders, and then when they do so, whether it would be more favorable to do a dividend or a share buyback. So, first is this core principle that companies will eventually return cash to shareholders. The purpose of a publicly traded company is to maximize value for its equity holders. Value is maximized by increasing the present value of a business's future cash flows attributable to equity holders, because this is just more cash that a business can return to their shareholders. So eventually, over the lifetime of a company, all of the cash generated will be returned to shareholders. A company might not be returning cash now, but there's the assumption that over the lifetime of a company, they eventually will. Equity investors derive all value from the prospects of a company returning cash to shareholders. If a company came out tomorrow and said, hey, sorry, we're never going to return any cash to you forever, then this would mean that this stock is essentially worth nothing to you because there's no future cash flows associated with it to you, right? It could still be, people still might be willing to buy it because it's like a trading card for the business, but intrinsically it would be worth nothing to you. So there's this assumption, even businesses that don't return any cash now, eventually at some point in the future, they will return cash to shareholders. So you should view stocks as investments, as a claim on the assets and future cash flows of a business. A stock has value because of the expectations of cash paid from the company to the stockholders at some point in the future. So therefore, one should only expect a company's stock price to go up if the company has more favorable future cash flow generating abilities. You shouldn't just think, oh, this company has a lot of hype, a lot of people are going to buy in, the stock's going to go up. This is just speculation on supply and demand. This is not actually investing and understanding the business and knowing that you're just investing in a portion of a business and the assets and future cash flows that the business produces. This is just pure speculation. And a lot of times this kind of rationale leads to bubbles within the market and then subsequent crashes. So you really shouldn't think of it like this. You should think of it as an investment. So there are two ways for a company to return cash. They can do so with a dividend or a share buyback. Dividends are cash payments to shareholders, either made regularly, like every quarter, or sometimes on one-off occasions called special dividends. So a regular dividend would just look like maybe a stock is worth $20 and the company issues maybe half a dollar of a dividend every quarter, right? Whereas a special dividend would typically be kind of a one-off thing where the company has a lot of cash on their balance sheet and they're like, we're just going to give a lot of this cash back to the shareholders. So that's kind of what dividends look like. And then share buybacks involve a company buying back their shares, either on the open market, which is just them going on the stock market and buying back the shares for whatever they're trading at, or through a tender offer, which is them making an offer to all their shareholders to sell their shares at a certain price. So maybe the stock's trading at 100 shares and the company comes out and says, hey, if you give us your shares for $102, we'll take them. And then after they get these shares back, after they buy them back, then the company will retire these shares. So they will have no more claim on the company. So maybe there's a company that has 10 shares. So everyone that owns a share has a 10% claim on the company. If the company were to go out and buy back 5 of those 10 shares, then now the people that don't sell their shares and still hold on to them would own a 20% stake in the company instead of a 10% stake, because half of the people are getting bought out. So when should a company return cash to shareholders? Put simply, a company should only return cash to shareholders when they don't have any reinvestment opportunities that would yield a higher return than if the shareholders just had the cash themselves to reinvest, right? A person is putting their money in a stock because they want it as an investment, right? They want the company to flourish over time. However, sometimes companies don't have any more areas to flourish in. And at that point, if they have no more good reinvestment opportunities, they should just return that cash to the shareholders so that the shareholders can invest it in something else that will have more opportunities and be able to offer them the return that they actually want to generate. So Warren Buffett is famous for never giving out any dividends for his company, Berkshire Hathaway. And the reason for this is that his company is an investment company at its core, right? So Warren Buffett believes that he can invest his money better than if he were to just return that cash to shareholders. So there's no reason for his company to issue a dividend to his shareholders. While they have done some buybacks, which I'll talk about later, they've never done a dividend because of this core assumption that they have better reinvestment opportunities and they'd be able to return or make a higher return than the shareholders would if they had the cash themselves. So this is nice and a good statement, but how can we quantify this? We can do this by looking at ROIC and WACC, return on invested capital, and weighted average cost of capital. So return on invested capital is measuring the return that a company gets on capital that is invested into the business operations. It's kind of measuring the return on your reinvestment opportunities. You can kind of think of it as IRR. It's essentially internal rate of return for your reinvestment opportunities. And ROIC equals NOPAT over invested capital. So it's what is my net operating profit after taxes when I invest a certain amount of capital in the business. So you should look at ROIC incrementally. I invest this amount of capital back into my business. How much does it increase my NOPAT by? And this incremental ROIC should be compared with weighted average cost of capital to see if a company should return cash to shareholders. WACC is the expected rate of return for the investors of a company. So if a company cannot meet that rate of return when they are investing capital, then they should just they should just return that cash to shareholders because they don't have any other good reinvestment opportunities. This is the way that a company's management should think about capital. If they can earn an ROIC above WACC, then they should deploy that capital. But if they can't, then they shouldn't. So this is the framework you should think of. If incremental ROIC is above WACC, then they should reinvest that money. This would be creating value, would be increasing the present value of the future cash flows for the business. If incremental ROIC equals WACC, then it doesn't matter. Let's say they're both 5%. This would not create value or destroy value. Value would stay the same no matter what, so it doesn't really matter what you do. But if incremental ROIC is less than WACC, then the company should return it to shareholders. So if the company were to reinvest this money, it would destroy value. So they should actually just return it to shareholders. Because if they were to invest that capital, let's say they got a 1% return on invested capital, but that capital cost them 10% to deploy, WACC was 10%, then this would be effectively decreasing the present value of the future cash flows for that company. So they do not want to deploy this capital. A common misconception is that all growth is good for companies. A company should deploy more capital so that they can grow their revenue, and this is great, right? You want to expand your business, but that's actually not true. You could deploy capital and it could still grow your business. But if the return on that capital deployed is less than WACC, then it's still destroying value and you don't want to do that, even if it could lead to growth. So this is how you should think of it and how a business should think quantitatively when deciding if they want to deploy capital or return that cash to shareholders. So why are buybacks the more effective way to return cash to shareholders? They're both returning cash to shareholders, but buybacks are more effective in most cases. Buying back shares is value creative for continuing shareholders when the shares are trading below their intrinsic value. This is because the company is effectively buying people out that have claims for a discount. So all the other shareholders that don't sell their shares benefit. For instance, let's say me and 4 of my friends have a company that's worth $5 million. We each have a 20% stake, so each of our stakes is worth $1 million. But let's say my friend Bob wants out of the company and he's willing to sell his stake in the company for $500,000 for whatever reason. I guess he just really wants out. This would be great for us, the continuing shareholders, because now we have to buy him out. So we're spending $500K to do that. So now the company's worth 4.5, or the company's equity is worth $4.5 million, split amongst the 4 of us. So this would be a bit more than $1.1 million for all of us. Our claim just went from 1 million to 1.1 million because we bought Bob out. So while a dividend isn't really value creative or value destructive when kind of using this philosophy, a share buyback actually can be value creative for the individual equity holder for a company. It's not actually increasing the value, the present value, the future cash flows for a business, but it's kind of shuffling around the claims of the company's equity holders in a way that provides value for them as equity holders. So this is got a good example from Breaking Bad, if you've seen the TV show. In Breaking Bad, Walter White started a technology company when he was in his 20s. So he owned 1/3 of the equity in Gray Matter Technologies, and he willingly sold his share in the company for $5,000 in the 1980s, early on in the company's history. He just really wanted out of the company. He had some beef with the other 2 people that started the company with him. So After he sold his share, the company went on to fame. It was eventually worth more than $1 billion. So by buying Walt out, this was extremely value creative for Gray Matter's continuing shareholders, the other two people, because they basically got rid of one of the other stakeholders for $5,000, which ended up being essentially nothing. So now they got each a 50% claim on the company's assets and future cash flows, which is great for them. So while returning that cash to Walt, reduced equity value at the time. Cash left the business, right, to go to Walt. It was extremely value creative for the continuing shareholders to make that decision at the time. They could have reinvested that money into the business rather than giving it to Walt to buy him out, but it probably would have not been as value creative because $5,000 to buy out a guy that owned a third of the company when the company ended up being worth $1 billion is extremely value creative for them, right? Instead of, let's say it was worth $1 billion, each of the stakeholders having $333 million and change effectively. Now they have $500 million each, the two people that stayed on. So this is a $167 million increase in their equity value for both of them because of this one decision to deploy $5,000 in capital to buying one of the other stakeholders out. So this is when share buyback can be very value creative for the continuing shareholders. While this $5,000 that was given to Walt didn't actually change the present value of future cash flows, it shuffled around the claims in a way that was very value creative for the continuing shareholders. So share buybacks, it is important to note that share buybacks do not change equity value differently than dividends do, right? Equity value is just enterprise value enterprise value plus cash minus debt. So cash is leaving the business, so equity value is decreasing by whatever the amount of the dividend or share buyback is. It's not actually they're not actually different, right? Doing a share buyback or dividends, both decreasing equity value by the same amount. However, share buybacks shuffle around the claims on a business's equity in a way that could be value creative or value destructive for continuing shareholders. If the stock is overvalued, buying back shares is value destructive for continuing shareholders because they're buying out someone at a premium to what their equity is actually worth. Let's say in that example with my four friends where our company is worth $5 million. If we bought one guy out at $2 million, this is a premium to the $1 million that the share is actually worth. This is value destructive for all of us because now the business is going from $5 million to $3 million because we're paying him $2 million. And that's split amongst the four of us. So our claim went from being $1 million to 3 divided by 4, $750,000. So this would be value destructive for us continuing shareholders. But if the stock is undervalued, buying back shares is value creative for continuing shareholders, as shown in the Walter White example. And if the stock is fairly valued, buying back shares is effectively the same for continuing shareholders as a dividend. There are a few tax implications here, but we're just going to ignore them for the sake of the video. The law on taxes is always changing. Just this year, there was a new change in the Inflation Reduction Act where share buybacks have got an increase in taxes. But in the past, share buybacks have been more tax efficient for investors. And it's also important to note that share buybacks aren't rude to the people that are not continuing to be a continuing shareholder. It's not unfair for them because they are willingly selling their shares to the company. They want to do this. It's not like we're extorting them and like, hey, you have to sell their share in the company at a price that's undervalued. They're willingly doing this. So oftentimes a company will do this when their management is just really confident in the value of their company and people don't realize it. So a good example of this is Berkshire Hathaway. While Warren Buffett's company has never issued a dividend before, quite famously, they have bought back shares occasionally when they deem the shares to be undervalued, which has happened in periods of market decline. Berkshire Hathaway is known for buying back some of their shares, which is technically returning cash to shareholders, which they think is to the benefit of the continuing shareholders that don't sell their shares. These buybacks can be seen as the company investing in themselves, as if the company succeeds in producing high cash flows, the continuing shareholders will have a higher claim on them. It's not that they're investing in themselves as if the company now owns their own stock. It's that they're so confident in their ability to do well and produce high cash flows that they're like, oh, well, because we bought some people out, now you have a higher claim on our great results, which is good for you. So they're basically, when you say investing in themselves, which is a common way to thing that people say when a company does buybacks. It's really them investing in their performance, and the stakeholders that continue to be in the company will benefit if they perform well. And since these buybacks are in and of themselves value creative for equity holders, a company should make sure that they have no better value creative alternative reinvestments before buying back shares. Just the same way with returning cash through a dividend, right? They should make sure that even though this could be value creative for equity holders if they're buying it back at a discount, there are always good reinvestment opportunities. So you have to consider that as well. And I just want to reemphasize this one more time because this is a bit confusing. When you issue a share buyback or do a dividend, you're not changing enterprise value. Enterprise value is just the present value of future cash flows. So you're not changing that. You're giving cash away that you have right now. So this will change your equity value because equity value is enterprise value plus cash minus debt. Getting rid of cash will change your equity value. It's not changing enterprise value. So usually when we say value creative, we mean increasing the present value of the future cash flows, like enterprise value. When I'm saying value creative here, I mean value creative for equity holders specifically, because it's increasing their claim on the company, especially when the company's undervalued. And this is a really good claim to have. So the golden rule for share buybacks is quoted from Michael Mabuson's book, Expectation Investing, which I highly recommend. A company should repurchase its shares only when its stock is trading below its expected value and when no better investment opportunities are available. So two things that I said, it needs to be below intrinsic value and when there's no investment opportunities that would yield a higher return than buying back the shares. So here's an example quantitatively of if a company should buy back shares. So this is a bit complicated. There's a lot of numbers here, but don't be worried. I'll try to break them down as simply as possible. Let's say a company has a stock price of $50 with 10 shares outstanding. So market capitalization, the market deems the equity of the company to be worth $500. Yet management is confident and they believe the company's market capitalization is undervalued and should really be worth $1,000. The enterprise value, the future cash flows, the present value of them, which is $750, and the current cash in their balance sheet of $250. Just assume there's no debt. The company uses $250 in cash to buy back half of the shares outstanding. So they're buying them at whatever the market value is, right? 50 times 5, right? They're buying back half the shares. And this raises the fair value per share from 100 to 150 by using what the company believes the fair value of the shares to be, which is $1,000. If the fair value of the shares is actually $1,000, what management says, this is very value creative for the continuing equity holders because now the enterprise value is $750, right? That's just what the equity value is minus the cash, which they just gave away. So it's worth $750 now. And now there's only 5 shareholders left. So each shareholder's claim is now worth $150 as opposed to $100 like it was before. And this happened because not because the enterprise value changed, but because they were able to buy back other shareholders at a discount, right? And this is value creative for the continuing shareholders. So the way that a company would determine if they should do this, or if they should reinvest in the company, is by looking at the return that they would need to get on invested capital if they were to deploy the $250 instead of buying back people into the business. So let's say the company wants to reinvest that $250. The only way a company would be able to reinvest that $250 and create that much value as they move the share buyback would be to make their enterprise value $1,500 because now they're giving away the cash. So the cash is no longer involved in equity value. So it's just enterprise value. And the enterprise value would have to be $100 or $1,500 because $1,500 divided by 5 is $150. So that would be the value of the fair value of the continuing shareholders, which in this case would be 10. I did a miscalculation there. It says 1,500 divided by 5, but I need to say 1,500 divided by 10. So meaning, assuming WACC of 10%, the company would have to earn an incremental ROIC of 30% if they were to invest it elsewhere to make it worthwhile. So if they were not to do the buyback and they wanted to invest it in the company, they would need to get a 30% ROIC. And the math for that is below. If the company were to invest an incremental and earn an incremental ROIC of 30%, then that means they're investing $250 of capital, and 30% equals blank divided by 250. That would be 75, right? 75 divided by 250 is 30%, right? So, and an increase in NOPAT by $75, if you just take a perpetuity of that, which you can, just a perpetuity of that incremental increase, 75 divided by WACC. So you're assuming that for the rest of the company's history, they'll have a $75 increase in NOPAT as a result of this incremental investment. You can say that was worth $750 because 75 divided by cost of capital is the value of that perpetuity, that incremental increase of $75. So because of this reinvestment, EV goes from 750 to 1500, the previous 750 of the future cash flows, plus the 750 of this perpetuity, that because they were able to increase NOPAT. And we're using NOPAT and free cash flow kind of as the same thing here, making fair value per share $150. So the only way for the company to generate the same fair value per share for continuing shareholders, $150, by reinvesting the $250 versus just buying back shares, would be to earn an incremental ROIC of 30%. So they couldn't identify any projects where they could earn an incremental ROIC of 30% for that entire $250. They should just buy back the shares because this is the best thing for the company. This is interesting. And a reason why a lot of CEOs aren't willing to do this is because CEOs want to grow, right? If they're to do the latter, which is reinvesting, they're growing their company, which is great, right? They get more clout. They get to go on more fancy jets, get to be a part of more fancy like country clubs. But in reality, for shareholders, it's better to shrink their company in essence and buy back shares, not grow. This is better for the continuing shareholders, unless they were able to earn an incremental ROIC of 30%. Again, 30% because NOPAT needs to increase by $75 increase in the perpetuity. The perpetuity formula is just cash flow divided by WACC. So 75 divided by 10% is 750 on top of $750 of enterprise value before. So now enterprise value is $1,500. So the fair value of the share is $150, which is what it would be if they did the share buyback. So this is kind of the way you can quantify this, if you should buy back shares or reinvest. Obviously, this was a bit extreme because the company was really trading at a steep discount, at least in management's opinion, which is why you can't always be confident about these things. Management can't know for sure that their share is worth $1,000. You can kind of only ballpark this. So you have to be confident. If a management, they have to be self-aware, right? They can't just always say, my stock price is undervalued. It should be double what it currently is trading at. You need to be realistic in what the fair value, the intrinsic value, the present value, the future cash flows, plus the current cash is actually worth, right? So this is kind of the rationale that you should use when thinking of a dividend or share buyback. Share buybacks are a more effective way to return cash to shareholders than dividends, unless a company's stock is overvalued. If a company can't earn a return on invested capital above WACC and their stock is overvalued somehow, which is probably a rare double occurrence, then they should do dividends instead of a share buyback. This is the more value creative thing to do for shareholders. So I guess it's not value creative, but it's not value destructive. So it is the more value creative thing in essence. And second thing, a company should only pursue a share buyback if it cannot reinvest the cash into something that increases the value for continuing shareholders more than if they were to buy back the undervalued shares, as shown in the last example. So you should so you should think about it like I did in the last example. You should think, okay, if I were to do the share buyback, how much value would it increase for continuing shareholders versus if I were to reinvest in the business? And then lastly, a company should only issue a dividend if it can not earn a return on invested capital above the cost of capital and its shares are overvalued, which is kind of the same thing I said in the first bullet point. But just again, dividends should not be happening that often. It should only be if those first two instances are true. Share buybacks are extremely great for shareholders when the stock is undervalued. You shouldn't be doing a dividend in that case. You should be returning cash by buying back shares. So this brings us to this discussion of capital allocation, which is just a very important job for CEOs, management of company. All of these decisions are made by a business's management and can have a significant effect on the returns shareholders get over time. These little decisions like, should I buy back shares? Should I acquire another company? Should I reinvest that money? Where should I reinvest that money? Should I issue a dividend? Should I raise more debt? Should I raise more equity? All these little things have a big outcome at the end. The core operations of a business are important, of course, improving margins, increasing sales, but these little decisions should be thought of a lot, this capital allocation decisions. And it's extremely important that management makes smart decisions and follows the guidelines that I laid out. And it turns out that a lot of managers commonly do not do these because there's incentives that are misaligned. For instance, a lot of times CEOs will reinvest instead of returning cash to shareholders because they want to grow. They want revenues to be higher. They think that's what they should do because, it increases clout for them. It makes the business look better on the outside, but it's not actually value creative for shareholders if they're not earning a return on invested capital above cost of capital. And the second thing, buying back shares, not because they're undervalued, but to increase earnings per share. Earnings per share, just earnings divided by shares outstanding, which is commonly a metric that is used to decide a manager's pay. Obviously, if you're buying back shares, it's decreasing the denominator, the amount of shares. This would increase earnings per share. So a lot of times, companies will just buy back shares because they're like, oh, we need to increase earnings per share. But that's not actually value creative for the company's existing equity holders if the share's overvalued. So the company should think if it's undervalued or overvalued, not if it's increasing earnings per share. That's not a good way to think about it, even if it looks good for shareholders because they're not being diluted or because the manager gets their bonus and because high EPS looks good. It's not actually value creative. Earnings in general was kind of a flawed metric. It's better to use free cash flow. Issuing dividends instead of buybacks, even though buybacks would be more value creative. This is the last thing. While buybacks are becoming more common, dividends are still issued a lot when the company's stock might be undervalued. So it's important to understand why buybacks are so good. There's misconceptions out there that buybacks are good because, it increases earnings per share and then earnings per share goes up, so the stock price goes up. That's not true. That's not how you should think about it. That's not even how the investing works, right? That's not how the present value of the future cash flows was cast. It's not changing that intuitively. It's not just all about multiples. Sorry, there's a bit of a rant here. There's a lot of misconceptions out here, even if you look at the Investopedia article for buybacks. But hopefully you learned some stuff in this video. In conclusion, when a company does not have reinvestment opportunities that would earn a higher return than the investors could earn if they had that cash, companies should return that cash to shareholders. That is the way to maximize the value for equity holders. Because if you were to reinvest that money, you'd be destroying value. So you should just give that cash to shareholders and let them do what they want with it. And the dividends for share buybacks are almost always more favorable for dividends. If the stock is undervalued, a company should do a buyback instead of a dividend. If the stock is overvalued and there's no good reinvestment opportunities, the company should do a dividend instead of a buyback or reinvesting. So that's all for this video. I hope y'all enjoyed it. Comment below if you have any questions. Hope you all have a good day.